Chapter 9. Taking and Mitigating Risks, Consumer Credit, Insurance, and the Government. Don't be too timid and squeamish about your actions. All life is an experiment. The more experiments you make, the better. Ralph Waldo Emerson, 1841. Introduction. Household well-being depends not just on the level of income, but also on its volatility. This chapter is about institutions, particularly consumer credit and insurance, that allow the household to enjoy a standard of living that is less volatile over time. Consumer credit allows for the purchase of homes and consumer durables by spreading out payments over time and avoids the need to save the entire purchase price in advance. Insurance helps to reduce volatility by providing payments to compensate for losses of income during spells of unemployment, for catastrophic losses from fire, and for the loss of life of the breadwinner. We begin with consumer credit and mortgage finance. Was consumer credit a new invention of the 1920s that allowed the consumer durables boom of the 1920s to occur? Were the fundamental changes in mortgage finance that facilitated the building boom of the 1920s that endowed America with a surfeit of office buildings, residential apartments, and houses? The oldest financial institutions are maritime insurance and life insurance, which can be dated back to the Phoenicians. How did insurance evolve during our period of 1870 to 1940? This chapter also covers the role of government, mainly in mitigating both microeconomic and macroeconomic risks as it made the transition from the laissez-faire regime of the late 19th century to the multidimensional interventions of the New Deal. During 1870 to 1940, the American economy began its long transition to a mass consumer society. In the late 19th century, when the majority of Americans belonged to the working class, often having arrived directly from Europe, most households lived a meager existence, spending half or more of the family income on food and drink. Yet by 1940, disposable real incomes had risen sufficiently to allow the purchase of goods that would have been considered unattainable luxuries 50 years earlier. And by 1940, almost every urban housing unit was networked, connected to electricity, gas, telephone, running water, and sanitary sewage pipes. There was enough discretionary income for families to begin buying electric appliances, and by 1929, motor vehicle registrations per household had reached 93%, starting from zero in 1900. How did families pay for the massive number of houses built in the roaring 1920s? Did they have access to mortgage finance and consumer credit? If so, then when did those elements of consumer finance begin, and what was the process by which they spread? Modern forms of installment buying may have been expanded in the 1920s, but a pervasive reliance on consumer credit dates back to the early 19th century in the forms of rural general stores that offered credit to their farm customers and of pawnbrokers who similarly offered credit to their urban clientele. Was fire and life insurance always available? And what was the nature of automobile insurance in the first few decades after the motor vehicle was invented? The first part of this chapter is devoted to consumer finance, insurance, and the mitigation of risk. Risk and uncertainty can be viewed as an externality, a byproduct of industrialization and urbanization for which the barons of industry did not have to pay. Even in the laissez-faire environment of the late 19th century, the government intervened in the development of the economy in numerous ways. Government actions included a wide range of legislation, the granting of land to railroads and homesteading settlers, food and drug regulations, the establishment of land-grant universities and agricultural research stations, the patent system, deposit insurance, Social Security, and unemployment compensation, to name the main government programs that promoted economic development, mitigated risk, and increased security and well-being. Borrowing on the farm and in the city. Early forms of consumer credit. In the late 19th century, consumer credit was universal in rural America. Farmers purchased goods such as shoes, clothing, coffee, and alcohol from the nearby country store, which extended credit that was often not repaid until the next harvest. It was common for farmers in the North and West to buy horses, carts, harnesses, furniture, and seeds, half of the payment consisting of cash and the other half in the form of a bill to be repaid after the harvest. The administration of credit, including for dry goods and notions from the nearest general store, was informal, and customers were expected to repay when they could. There was a very low incidence of non-payment, as this would have resulted in a suspension of credit privileges and would have meant a loss of respect for farmers and their families in close-knit farm communities where neighbors knew their neighbors. In the beginning of the 19th century, payment of debts was a virtue and inability to pay them was a mortal sin. Credit was developed earlier and more freely in the United States than in many European countries, in part because the typical American farmer, outside the South, owned his own land. Whereas in Europe, tenant farming was more common, with large estates owned by upper-class families through inheritance over generations. Whereas in Europe, the avaricious lender faced a social stigma for ideological reasons, usually religious. In the United States, the borrower experienced the stigma, being considered a penniless failure. The traveling salesman supplemented the role of the country store in providing credit to isolated farms and small towns alike. Finance for these salesmen was provided by wholesalers who were eager to sell their goods in the remote parts of rural America, and the backup finance ultimately traced its way back to Chicago or New York. Such was the heavily leveraged world of frontier exchange. Everyone owed money to everyone else, and for much of the year the only way to sell anything at all was to do so on time. It was little wonder that frontier interest rates were so high. Urban banks and wholesalers lent their credit to small-town merchants, and they in turn lent merchandise to their rural customers. It was a risky world, with bankruptcy of foreclosure lurking around every corner. Thus, a farmer could simultaneously save face and maintain his social standing with his rural community by paying his bills for the small items purchased from the local country store, but face bankruptcy or foreclosure of his entire farm as the result of a catastrophic event affecting all his fellow farmers, such as a crop failure caused by drought or a nationwide decline in farm prices, as occurred in 1920 to 21, or in the Great Depression of the 1930s. Farmers/owners in the North borrowed not just from the general store for everyday purchases, but also from local banks to buy their land and build their farmhouses. Because loans on farmland were not granted for longer than 6 to 8 years, borrowers were regularly in the market, securing new mortgages, paying new origination fees, and coping with unpredictable interest rates. The late 19th century was an era of deflation, which reduced farm prices and farm incomes, and the nominal value of debts was fixed and not responsive to economy-wide deflation. Farmers were further disadvantaged by the lack of a central bank and a national banking system. The farther a farmer/borrower was from New York City, the higher the interest rate he was likely to pay. Effective real interest rates in the North were at 10%. In between small purchases of everyday items at the general store and the purchase of land and materials to build a house, farmers also needed to finance the purchase of large pieces of newly invented farm equipment. In 1850, the farmer used equipment little changed since biblical times. But new inventions, such as the McCormick reaper, offered gains in productivity, if the farmer could afford to buy the machine. The contrast between a farmer's annual gross income of $600 and the $100 to $150 price of a McCormick reaper in 1850 was daunting. As a result, McCormick offered a $125 machine for a down payment of $35, with the balance due after harvest. This was not installment financing, however. The balance had to be paid as a lump sum. Debt was a more important issue for Southern sharecroppers, for they did not own their land, buildings, or animals, but rather worked for the owner/landlord. The tenants were paid a fraction of the value of the crop at the end of the harvest, and that fraction depended on the extent to which inputs used by the sharecropper had been provided by the owner. Harvest receipts were available to repay the debts that had been run up over the prior year, and often the debts could not be covered in full. The outstanding debts turned sharecropping into a form of servitude, and violence could occur if a sharecropper tried to escape to another location to avoid his debt obligations. Interest rates charged to sharecroppers could range from 40% to 60%. The accumulation of unpaid debts year after year was called debt peonage, and the high level of physical mobility in the rural South is indicative of a degree of freedom that contradicts the notion of widespread debt peonage. The use of crops to be harvested in the future as collateral for loans in the southern states allowed small farmers to obtain credit under the crop lien system. The harvested crop was brought to the lien holder, who sold it and used the proceeds to pay off the farmer's debts. Because roads and railroads were rare in the South, the merchants at rural crossroads had a local monopoly and exploited it. The crossroads merchant thus profited both as a lender and as a crop broker. The role of the coal mine owner was similar to that of the landowners in the rural South. Debts contracted at company stores were deducted from paychecks. The tying of local miners to debt-financed and overpriced purchases at the company store impoverished the miners and prevented them from moving away. Urban pawnbroking dates back to medieval times, and in American history to colonial times. But its role in providing consumer credit became more prominent in the early 19th century with the development of dense urban centers. The services of pawnbrokers were tied to the unpredictable nature of urban employment, which, as we learned in Chapter 8, was unstable as a result not only of the macroeconomic business cycle, but also of the instability of employment in particular industries and at particular plants. In the Chicago stockyards, an employee returning home from work on Monday did not know whether he would be offered 4, 8, or 12 hours of work on Tuesday. The pawnbroker's cycle of pledging and redemption followed weekly and seasonal patterns. Weekly events included paychecks and due dates for rent payments. Seasonal events included the pledging of winter clothing in the spring to be redeemed in the fall. In 1935, a famous New York City pawn shop recorded pledges of a silver and gold watch, a piece of cashmere, corsets, and a telescope. Pawn shops became vehicles for disposing of stolen articles, and regulation of pawn shops by the late 19th century included limits on interest rates as well as requirements that all items and the identity of the pledger be registered with the police. Modern consumer credit originated as early as 1845, with installment sales of pianos and organs. Rising incomes allowed families, particularly in the middle and upper classes, to purchase substantial pieces of furniture, including large dining room tables, buffets, and sofas. Pawnbroking was not suited to provide loans on these large objects, which could not be conveniently transported as collateral. Instead, chattel lending developed, in which the collateral was not the object itself, but the legal title to the object. This new form of lending had the additional appeal of confidentiality. In 1850, the Singer Sewing Machine Company began to sell its machines on installment to consumers through agents. By the 1870s, such a machine could be purchased for as little as $1 down and 50 cents per week. This stage of installment purchases extended beyond the prosperous classes to working-class households, including recent immigrants. The late 19th century also brought the development of wage assignment loans, similar to today's payday loans, in which the collateral was a legal claim on the future wages of the borrower. Administering these loans required new types of information gathering, as borrowers could lie about the amount of their wages or the security of their employment. Lenders tended to favor workers who had stable employment, such as government or clerical workers, and they sometimes resorted to bribes to gain access to the payroll records of their borrowers. In the event of failure to repay, the lender could apply to garnish a portion of the borrower's wage. Before legal measures had to be invoked, however, the lender usually was able to coerce repayment based on the social stigma of debt. Chattel and wage assignment loans were carried out in the fringes of the legal system, surviving because of lax enforcement. More sinister were the lenders who explicitly flouted the state-enforced usury ceilings. Small lenders charging high interest rates were universally labeled loan sharks. How can men be so reckless as to borrow from these agencies that are everywhere known as sharks, leeches, and remorseless extortioners? It is clear that the majority of borrowers have been overtaken by sudden emergencies which, under their standard of living, cannot be met out of income. These small lenders trapped borrowers facing a legitimate financial emergency into a state of indebtedness characterized by usurious interest rates and collection techniques that sometimes relied on violence, often with the connivance of corrupt police, courts, municipal public servants, and payroll employees. Because these forms of credit were part of the underground economy, no records exist regarding their importance or magnitude. The subterranean world of working-class credit in the late 19th century differed little from that of 2 centuries earlier, which had been described by R.H. Tawney as spasmodic, irregular, unorganized, a series of individual and sometimes surreptitious transactions between neighbors. Rather than observing a straightforward shift from cash to credit in retail purchases during 1870 to 1940, we find that the transition was U-shaped. Initially, credit was dominant in rural America, and it played a substantial role in the form of urban pawnshops. Urbanization brought a shift from credit to cash. In 1910 to 12, the ever-growing A&P chain of food markets eliminated credit and converted to a cash-only policy. In the early years of the retail revolution created by large urban department stores and by mail-order catalogs, most merchants required cash payment. The department stores were able to reduce prices compared to smaller stores primarily through economies of scale, but also by refusing to discount and selling primarily for cash. The elimination of haggling and bargaining made each purchase a straightforward transaction that could be handled by a clerk without the need for a manager's involvement. However, competition among the department stores, at least in the large urban centers, slowly fostered a switch from an all-cash policy to the availability of charge accounts, initially for only the wealthiest patrons. As late as 1902, Macy's in New York maintained an all-cash policy, whereas Wanamaker's in Philadelphia had begun to offer installment payments with no down payments for selected large items, including pianos. Joining Macy's with an all-cash policy at the turn of the century were J.C. Penney and the catalogs of Sears, Roebuck, and of Montgomery Ward. The credit policies of the great catalog merchants are recorded in the introductory pages of their thick books of offerings. Though Sears began in the late 1890s by offering COD, cash on delivery, as contrasted to cash sent with the initial order, by 1902, COD was eliminated, and all purchases had to be paid for in cash up front. In the payments technology of 1902, this meant the payment had to be submitted, quote, by post office money order, express money order, bank draft, cash, or stamps. We do not accept revenue stamps, foreign stamps, and due stamps, as they are of no value to us, end quote. The introductions to the annual catalogs are some of the most overwritten in the history of advertising. The introduction to the Sears 1902 catalog approaches 10,000 words in a tiny typeface, but has a refreshing honesty. The message was clear that Sears customers constituted an egalitarian democracy. There was no discounting to any buyer, no matter how large. There was no provision of credit, because the clerical and interest expense of credit would imply a higher cost of goods for the normal cash-paying customer. The catalog cost 50 cents and was not distributed for free, so to hold down the cost of goods. These excerpts from the first 2 pages provide a flavor of the egalitarian approach. In order to maintain our incomparably low prices which, quality considered, are not and cannot be met by any other house, we are compelled to ask our customers to invariably send cash in full with their orders. We have discontinued making COD shipments, with a view to naming still lower prices, giving greater value than ever before. Any house that ships goods by express COD makes it impossible to furnish their customers the same values we quote on the upwards of 100,000 items in this catalog. By getting 50 cents for our big catalog, thus doing away with nearly all advertising expense, we have effected a very great saving which has changed our selling prices accordingly. The shift toward cash payment during the 1890 to 1910 period and then back again to credit should not be exaggerated. During the peak years of immigrant arrival between 1900 and 1913, there were between 5,000 and 10,000 peddlers on New York's Lower East Side selling goods from house to house. The peddlers acted as middlemen between local retailers and the closely packed customers in the large tenement blocks discussed in Chapter 4. Their retail suppliers provided credit to the peddlers, which allowed them to sell on credit to their customers. A memoir recalled how in 1899, the author's mother bought a silk tablecloth from a peddler for nothing down and 10 payments of 25 cents per week. When payments were made with cash rather than by credit, what did cash mean? The above list of payments accepted by Sears included money orders, blank drafts, cash, i.e. currency, and certain types of stamps. Not mentioned were personal checks, which, unlike bank drafts, carry the risk of bouncing if there are insufficient funds in the account. The distinction between payments by personal checks and by currency and coins varied across the type of transaction and the social class of the purchaser. Checks were used for all but the smallest purchases by the middle and upper classes. Currency and coins were used for small transactions by the middle and upper classes, and for all transactions by the working class. A 1910 report shows that in the prior year, 75% of retail bank deposits had been made with checks, 21% with currency, and 4% with coins. Those deposits included both payments made at the same time as the retail transaction and payments of outstanding credit incurred for previous transactions. Buy now, pay later comes to dominate consumer durable purchases. Early forms of credit, such as rural loans at the general store and in southern agriculture, called for lump sum repayment of the principal amount, usually at harvest time. Urban pawnbrokers gave loans on pledged goods and accepted a lump sum at the time of redemption. In these and other examples, the borrower repaid the loan in a single payment, a financial obligation that was daunting in the context of the low average incomes at the time. The development of the installment plan avoided the need to save up for a full repayment of the balance due. Instead, the borrower was required to repay the loan with fixed installments to be made at regular frequency over a stated period, with the interest charge built into the periodic payments. The installment plan is often credited with the creation of the American Consumer Society and particularly the durable goods and housing booms of the 1920s. But as we have seen, furniture, pianos, and sewing machines were sold to high-income families as early as 1850 on terms of 1/3 down and additional payments over the next 2 to 3 years. Despite the absence of credit reports in the 19th century, installment credit resulted in few defaults because lenders were highly discriminatory in limiting credit to high-income families or those middle-class families who appeared to have stable lives and marriages, and jobs that were likely to be free of business cycle or industry volatility. The early years of the 20th century witnessed a rapid conversion of consumer credit. There arose a new world of consumer finance available to most of the working class that was continuous, regular, organized, a series of increasingly impersonal, often visible bureaucratic transactions between individuals and institutions. By the 1920s, phrases such as "buy now, pay later" had become commonplace. The new age of consumer credit was called by its enthusiasts a revolution second in importance only to the great shift from handicraft to machinery. Over the period between 1905 and 1915, the previous cash-only department stores began to offer installment plan purchases of furniture and large items of household equipment that could be repossessed, as did the mail-order catalog houses. Though most major department stores operated in 1900 on a cash-only basis, they had all converted to credit accounts by the 1920s. Marshall Field's charge business in Chicago had increased by 1929 to 180,000 accounts, double the 1920 number. Most large department stores found that sales on credit made up 50% to 70% of their business. The number of regulated small loan offices increased by a factor of 6 between 1913 and 1929. As compared to the loan sharks and pawnbrokers of the late 19th century, these large and impersonal sources of consumer finance were more aggressive in collecting payments and less tolerant of temporary personal misfortune. In the 1920s, consumer finance companies could retaliate against late or incomplete payments by garnishing wages and taking defaulting customers to court. Although the stock market collapse of late 1929 is often cited as a major cause of the Great Depression, the over-reliance of households on consumer credit and their increased leverage added to the downward spiral of collapse and deflation once incomes and jobs began to be cut in 1929 to 30. Few inventions have ever spread as rapidly as did the automobile between 1900, when there were no automobiles on the roads, to 1929, when the ratio of motor vehicles to American households had reached 93%. The installment plan was to consumer credit what the moving assembly line was to the automobile industry. The integral role of finance began with the seasonal imbalance between supply and demand. The assembly line method of production required steady production to minimize costs. But in the early days of open cars, purchases were much higher in the summer than in the winter. The large automobile companies had sufficient leverage to force the inventory overage onto the local auto dealer, who in turn needed a way to finance the large seasonal inventory of unsold autos. The borrowing requirements of dealers led to the development of finance companies, often independent but sometimes owned by the automobile manufacturers. Martha Olney has described the development of these finance companies as a way to preserve manufacturer power over dealers while simultaneously solving the problem of inadequate wholesale inventory financing. Though automobile finance on the installment plan can be traced as far back as 1910, financing on a modern scale began in 1919 with the establishment of the General Motors Acceptance Corporation, GMAC. Although Henry Ford adamantly opposed installment buying, by 1919, 2/3 of Ford cars were sold on the installment plan, financed not by the Ford company itself, but rather by local finance companies that cooperated with Ford dealers. By 1924, 3 out of every 4 automobiles were bought on credit. The competition among manufacturers amid the explosion of automobile sales in the 1920s led to a gradual liberalization of finance terms. Starting from a 50% down payment and a mere 12 months to repay, soon down payments were reduced to 1/3 or less, and repayment intervals extended to 2 years. Olney has calculated that effective interest rates for car loans were typically 34% in the 1920s. Did the increased availability of consumer credit account for the durable goods sales boom of the 1920s? Olney's main hypothesis is that the increased availability of consumer credit created a major upward shift in the demand for durable goods, holding constant household incomes and relative prices. And indeed, her regression analysis finds that this upward shift occurred except for 3 types of traditional goods, largely unaffected by technological change: china, silverware, and house furnishings. But Olney's analysis is unconvincing, for she focuses entirely on demand, without considering the revolutionary changes in supply. New goods were for sale that previously had not existed, most notably electric refrigerators and washing machines. And the most important consumer durable of all, the automobile, experienced a radical decline in price and increase in quality between 1910 and 1923. The revolution made possible by the invention of electricity and the internal combustion engine, together with Olney's finding of no shift for traditional goods, china, etc., raises the possibility that the consumer durables boom of the 1920s resulted from the availability of newly invented products at greatly reduced prices rather than the availability of consumer credit. Thus, the availability of new products fueled the provision of consumer credit, and at the same time the availability of consumer credit facilitated the purchase of the new products. Figure 9.1 compares the percentage ratio of non-structures debt as a percentage of nominal GDP with real consumer durable expenditures as a percentage of real GDP. The graph raises the question of whether there actually was a durable goods boom in the 1920s. The GDP share of consumer durables had ranged from 5% to 6% between 1900 and 1910, and in the 1920s the share rose slightly above 6% for 5 straight years from 1925 to 1929. This hardly qualifies as something remarkable that needs to be explained. The relatively flat percentage of consumer durables spending suggests that, however rapid the growth of durables spending, the sum of the other components of GDP, consumer non-durables and services, investment in structures, government spending, and net exports, was growing just as rapidly. Unlike the ratio of real consumer durable goods spending to real GDP, the ratio of outstanding consumer credit balances, shown by the gray line in Figure 9.1, grew rapidly from 1900 to 1915 to 1916, then collapsed until 1919 to 20, then expanded rapidly through 1929 to 30, and then drifted down until 1934, when another burst of growth brought the ratio by 1941 far above the 1929 ratio. The role of causation between consumer credit and consumer durable expenditures is dubious. The credit ratio rose from 3.6% to 8.6% between 1900 and 1939, whereas the consumer durables spending ratio actually declined from 5.7 to 5.0% over the same interval. The increasing availability of credit appears to be a phenomenon largely independent of the rise and fall of the share of consumer durables in total spending. During the 1920s, the market for durable goods was transformed to a credit-based system of purchase, comparable in most ways to the post-war years. By 1929, installment credit financed the sales of 61% of new cars and 65% of used cars. And automobiles were not alone. It has been estimated that in the late 1920s, consumer credit financed 80 to 90% of furniture, 75% of washing machines, 65% of vacuum cleaners, 18 to 25% of jewelry, 75% of radio sets, and 80% of phonographs. The use of credit for luxury items, as automobiles and electric appliances were perceived to be in the 1920s, reversed the previous image of social stigma associated with borrowing. It brought to the working classes the ability to purchase newly invented products that had not even existed a generation earlier. Credit came to be seen as the greatest catalyst in the famous melting pot. By creating the base for a large market, it facilitates mass production, and therefore an enormous reduction in unit costs. American economic vitality in the 20th century stems from this correspondence. The housing boom of the 1920s and its roots in the mortgage finance revolution. The first provider of installment loans was the U.S. government. The Harrison Act of 1800 provided for the sale of public land to farmers for a down payment of 25% and 3 additional payments stretched out over up to 4 years. A total of 19.4 million acres of land in the Northwest Territories was sold in this way between 1800 and 1820. As early as 1890, census data shows that 29% of homes in the United States had outstanding mortgages. For instance, in the Boston area, it was typical for a family to be required to save half of the purchase price, say $1,500 for a $3,000 house, and borrow the rest. Then a first mortgage would be obtained from a savings bank or mortgage dealer for 40% of the sales price, $1,200, at an interest rate of 5 to 6%, and a second mortgage for $300 was obtained from a real estate agent. Interest was paid semi-annually over 3 to 8 years, and the lump sum of principal was due at the end of the loan period. The details of mortgage contracts differed between and within cities, with some loans extending for as long as 20 years. The largest holders of mortgage debt were individuals, savings banks, and building and loan associations. The latter pioneered amortized loans, in which the monthly payment included both interest and repayment of principal, so that no lump sum payment was due when the loan matured. Though the inclusion of principal repayment raised the size of monthly payment, this was in many cases offset by extending the length of the repayment period. Amortized loans were a valuable innovation, for they reduced risk for both lender and borrower. By the 1920s, they had become standard. In the 1890s, most houses in Muncie, Indiana were built for rental, but the Linds estimated that in 1929 the rental portion had declined to only 10%. They attribute this change to the development of building and loan associations after 1900, which made it possible for many members of the working class to consider home ownership. In the mid-1920s, fully 75% to 80% of new Muncie homes were built for owners, with mortgages provided by 4 associations, and a bank executive estimated that 85% of those purchases were working men. A parallel financial innovation was the development of the real estate mortgage bond, which greatly facilitated the enormous but unsustainable boom in building both large and small apartment buildings in the 1920s. Builders could obtain money in advance of construction to finance the entire construction project, with only minimal down payment requirements. While only about $150 million worth had been sold before the war, total investment in real estate bonds is thought to have been approximately $10 billion by the early 30s. One reason home ownership rates soared in the 1920s as part of the massive building boom of that decade was a widespread loosening of credit conditions that allowed families to take out second and third mortgages. The value of outstanding mortgages soared from about $12 billion in 1919 to $43 billion in 1930, i.e. from 16% to 41% of nominal GDP. Figure 9.2 plots the ratio mortgage debt to GDP against the non-structures consumer debt ratio already examined in Figure 9.1. The differing left-hand and right-hand axes indicate that mortgage debt for structures during the 1920s was consistently 7 times higher than for non-structures consumer debt. The longer view in Figure 9.2 shows that the value of outstanding mortgages was roughly 20% of GDP from 1900 to 1922. Owing to the short-term character of non-mortgage finance and the economic recovery of the late 1930s, the ratio to GDP of non-mortgage consumer credit rose by 1939 far above its 1929 value. In contrast, though the timing of the expansion of mortgage finance in the 1920s was similar, its behavior in the 1930s was entirely different. The mortgage finance ratio spiked from 41% to 69% as the economy collapsed during 1929 to 32, and then, because there was so little residential construction during the 1930s, declined from 69% in 1932 to a mere 27% in 1941. Another confirmation that mortgage finance of residential structures exploded in the 1920s is provided by Figure 9.3. The ratio of residential mortgage debt to residential wealth increased from 14.3% in 1916 to 27.2% in 1929. The sharp decrease evident in Figure 9.3 between 1916 and 1920 is a result of wartime and post-war inflation, and the sharp increase between 1929 and 1932 is a result of deflation in the Great Contraction of 1929 to 32. The rise in price after 1933, together with the near disappearance of residential construction during the 1930s and the years of World War II, helps account for the decline in the debt-to-wealth ratio between 1932 and 1948. It was substantially easier to obtain credit for automobiles than for houses because the collateral for the loan was movable. And this helps to explain why automobile sales grew so rapidly in the United States compared to other countries. There are contrasting views on how difficult it was to obtain mortgage credit. The Lynn's statement that 80% of Muncie houses built in the 1920s were sold to owners, and that many of these new owners were working class, conflicts with Wood's unqualified remark that there was no mortgage finance available for families below the 50th percentile of the income distribution. Quote, "Beyond this, in a downward direction, they do not and cannot go." End quote. Overall, the most important support of the transition from rental status to home ownership was the evolution of credit institutions. Between 1890 and 1930, mortgages became easier to obtain, with lower down payments and more options for second and third mortgages. Home ownership rates crept up toward 50% in the nation as a whole. The positive stimulus from mortgage finance came at least temporarily to a halt as a result of bank failures in the early 1930s, and revived somewhat in the late 1930s, then changed completely to a much easier financial environment after World War II. Life insurance, the oldest financial institution. Insurance is the oldest form of the many financial institutions that directly affect the welfare of household members. As long ago as 900 BC on the island of Rhodes, sea law provided for contributions from the community to cover the losses of ships and cargo at sea. There started the practice of preventing a great loss for any one individual by the acceptance of a small loss by all members of a group. Life insurance developed by expanding the concept of maritime losses from the direct value of the ship and its cargo to the value of the seamen employed on the ships that were lost. During the 15th and 16th centuries, life insurance was derided as a form of gambling, particularly in France and Italy. Nevertheless, the Italians took the lead in the development of insurance, and the Italian province of Lombardy gave its name to London's Lombard Street, the origin of modern insurance in the 1550s. The first formal life insurance policy was issued in 1583 on a William Gibbons of London, and it was not only the oldest life insurance policy on record, but also the first known case taken to court for settlement. The first term life insurance in the United States was offered in 1759 to Presbyterian ministers in Philadelphia. Until the Civil War, life insurance policies were simple documents stating the amount and conditions of coverage and the amount of the premiums. There were no cash or loan values, and life insurance was not the instrument of saving that it later became. In the last 3 decades of the 19th century, life insurance was transformed into its modern form, with a large number of agents on commission aggressively selling policies with cash and loan value and flexibility to change beneficiaries. Life insurance was based on the idea that although death is certain, the date of death is highly uncertain. But for any group of sufficient size, the percentage of that group who will die in a given year varied little except during periods of war or epidemics. By the beginning of the 20th century, life insurance companies were regulated as to the percentage of outstanding insurance that had to be held in the form of assets available to pay benefits to policy beneficiaries. By 1900, life insurance became known as a method of forced saving that countered the tendency of heads of working-class and middle-class households to postpone saving. Like the installment plan of consumer credit, it was based on required relatively small periodic payments that forced heads of household to set aside savings for a future rainy day, including their own death. In a journal article from 1905, "It is not what passes through a man's hands, but what he holds on to, that gives him a competency. The holding on is difficult, and any device which helps a man to hold on to his earnings and turn them into earning capital makes for the prosperity of the country. Nothing so far has been devised which enables so large a proportion of persons to save under such easy conditions as life insurance. Hence its high rank in economic life." To the extent that the institution of life insurance raised household saving, it also raised domestic investment and fueled economic growth. Also, by providing a convenient vehicle of forced saving, it spared widows and their children from indigence or dependence on private or public charity. By the time of this 1905 article, the assets of life insurance companies had more than doubled as a share of GDP from 4.5% in 1875 to 10.4% in 1905, as shown in Figure 9.4. There was further growth to 14.5% in 1914, and then a decline to 8.4% as wartime inflation eroded the value of the nominal assets of the insurance companies, followed by a doubling to 16.9% in 1929, as insurance outstanding far exceeded the pace of nominal GDP growth in the 1920s. Just as the inflation of the wartime years eroded the GDP share of outstanding insurance, so the deflation and economic collapse of the Great Depression caused the ratio to soar to 37.0% in 1933, before beginning its descent due to economic recovery and the explosion of nominal GDP during World War II. Over long periods, the ratio grew at an annual rate of 4.0% between 1880 and 1905, by 2.0% between 1905 and 1929, and at a surprisingly rapid annual rate of 3.5% between 1929 and 1941. Thus, the late 19th century and the decade of the 1930s saw the fastest pace of expansion of life insurance outstanding as compared to nominal GDP. Changes in the ratio of life insurance company assets to GDP does not reveal the amount of insurance in force nor the distribution of premiums and benefits. In 1915, About 25% to 30% of the population had their lives insured by policies, roughly equivalent to the share of adult males to the total population. Thus, life insurance was close to being universal and covered not just the middle and upper classes, but nearly the entirety of the working class. The insurance covering workers' lives provided future benefits for their wives and children. Premiums in 1915 amounted to 2.8% of GDP, of which 2.1% was returned to society as death benefits, and the remainder covered expenses of the life insurance companies, with any remaining surplus being added to their investments. By 1926, insurance in force had reached $79 billion, or 81% of GDP, more than 6 times higher than life insurance company assets of $12.9 billion. Forced saving through life insurance made available policy loans, which in 1915 amounted to 15% of insurance company assets. Considering the uncertainty of employment from year to year, and even from week to week, as described in Chapter 8, life insurance loans provided a source of cash to tide over a family during periods of slack work for the head of a household. In addition, life insurance loans were also used to make down payments on consumer credit borrowing, as well as to make lump sum repayments at the termination date of consumer loans. The role of life insurance agents seems remarkable from today's perspective. About 20% of total life insurance premiums were collected by agents who made weekly visits, which were made not just to collect premiums, but also to pay dividends and bonuses, to prepare proofs of death, and even to pay claims. The agent enters into the daily family life of the wage earners. He knows all the family, their joys and griefs, their income and outgo, their pleasures, their work, their very life, is often their advisor, confidant, and friend, and always in a representative capacity. He is what he is to those millions of people because he to them is the company. They know the company is back of the agent. Agents may change, but the company is always with them. It was in the interest of life insurance companies to minimize the death rate of their policyholders, and by the early 20th century, most large companies provided information on personal health and hygiene. Several companies distributed millions of pamphlets on topics such as avoidance of tuberculosis, care of children, purity of milk, flies and filth, and a host of other potential hazards. Some companies even provided free medical examination and visits by nurses. This self-interested paternalism is similar to the Ford Motor Company's sociological department, discussed in Chapter 8, which regularly visited the homes of workers to make sure that they were married and well-behaved. Along with the commercial life insurance carriers discussed above, there developed side by side a system of life insurance offered by fraternal organizations. First offered in 1868, fraternal insurance grew until by 1915, it represented fully a third of life insurance in force, with the other 2/3 being provided by the commercial companies. This alternative system of insurance began when members of an organization were relatively young and healthy, and members were attracted by substantially cheaper rates than the insurance companies. But the fraternal plans failed to anticipate the inexorable process of aging of their members and accumulated insufficient assets to pay off their claims as members died. In New York State in 1915, fraternal orders held in assets only 2% of the benefit certificates that they had in force, in contrast to the 28% of assets held by the commercial insurance companies in the same year. As a result of inadequate asset holding, many fraternal insurance plans failed, and others were forced to impose on their members drastic increases in rates. As a result, between 1915 and 1925, the fraternal share of insurance in force fell from 33% to 15%. Fire and automobile insurance. Even today, The United States rates among the highest of all developed countries in the incidence of fires and deaths from fires. On average, during 1979 to 92, the death rate from fires in the United States was 26.4 per million, as contrasted to 5.2 in Switzerland and 6.4 in the Netherlands. Data are lacking to compare the incidence of major fires across countries over a consistent time series, but the historical record suggests that major fires that devastated large areas of central cities were periodic in the 19th century, but, on a per capita basis, destroyed more U.S. cities than those of Europe. Between 1849 and 1906, major fires destroyed the central areas of St. Louis, Chicago, Baltimore, and San Francisco. Since 1906, there have been plenty of fires that destroyed individual buildings or blocks, but none on the scale of the Great Central City fires that culminated with the 1906 San Francisco earthquake. Notably, the 1989 San Francisco Bay Area Loma Prieta earthquake, which was significant enough to cause part of the Bay Bridge to tumble into the bay, did not cause a fire. Fire insurance originated in England in the early 18th century, as entrepreneurs created companies to insure property owners against the disastrous loss of wealth that had occurred in London's Great Fire of 1666, when 3/4 of the buildings in the city were destroyed. As in the case of life insurance, Philadelphia was among the first American cities to develop fire protection in the form of 7 fire extinguishing companies by 1752, and in the same year was established the first fire insurance company in the United States, the Philadelphia Contribution Ship. Gradually, through the 19th century, fire insurance arrived at its modern form. Just as life insurance companies adopted an educational role and even medical services, so the fire insurance companies helped educate architects, builders, and fire departments about improved construction methods and other aspects of fire protection. The epical calamities that tested the resources and organization of the fire insurance industry were the Great Chicago Fire of 1871 and the San Francisco earthquake and fire of 1906. In the case of Chicago, 49% of the value of the lost buildings was covered by insurance, but there was widespread concern that the insurance companies would not honor their commitments. Indeed, 51 of the smaller insurance companies were put out of business by their inability to pay claims. Nonetheless, most of the claims were eventually paid, and rebuilding started immediately, with loans often secured by the value of land. Chicago's location at the intersection of waterways and as the nation's leading railroad hub secured its future, and funds for rebuilding were made available not just from insurance claims, but from investment funds pouring in from around the nation and the world. The San Francisco earthquake and fire can be directly compared with the Chicago event, because the price level changed little between 1871 and 1906. In San Francisco, total damage was between 2.0 and 2.5 times that in Chicago, and the percentage of damage covered by insurance was the same, roughly half. Even after some insurance companies defaulted, more than 80% of the insurance claims were paid. A fortunate aspect of the San Francisco event was that the detailed property accounts in the Hall of Public Records were not destroyed, which served as a basis for the settlement of insurance claims and other financial consequences of the disaster. Automobile insurance began with a similarity to ancient maritime insurance, to protect the vehicle or ship from damage to its human or material contents, or to outright loss. The main difference in the development of automobile insurance is that vehicles crashed into each other, rarely the case with ships, and a determination of fault had to be made. The 1920s, as in so many other topics in this book, were the pivotal period for the development of compulsory automobile insurance. Fatalities from accidents involving the recently invented automobile were more than 20 times more frequent than today, as measured by the decline in automobile fatalities per 100 million vehicle miles from 24 in 1921 to 1.1 in 2012. See Figure 11.6. Those early years of automobile travel resembled a free-for-all, and government agencies moved only slowly to provide stop signs and electric traffic signals. The higher rate of accidents and fatalities in the early decades of the automobile combines multiple factors. Flimsy, lightweight cars initially open to the elements rather than with closed bodies. The absence of driver training and driver's licenses. The dangers posed by poorly constructed two-lane roads. The absence of speed limits and police monitoring of speed. The absence of traffic control lights. And the absence of seat belts or any other safety equipment. Although the earliest automobile insurance policy was written in 1897, liability and collision insurance sales began to soar when states, beginning with Connecticut in 1925, enacted legislation requiring the purchase of automobile insurance. Other states followed suit slowly, and some states waited until the late 1940s and early 1950s to enact compulsory insurance legislation. The earliest policies resembled those of today in that they included protection for bodily injury for the occupants of both cars involved in an accident, for property damage to either car, medical payments, liability, as well as liability to protect against uninsured motorists, as well as collision and comprehensive coverage for minor incidents. By 1935, all these components had been integrated into a standard policy by the National Bureau of Casualty and Surety Underwriters. The two largest current providers of automobile insurance are State Farm and Allstate, the first founded in 1922 and the second in 1931. Both companies have in common that their business, then and now, has been based on an earlier life insurance business model in which individual agents sell policies, provide information, and settle claims. The difference between the two companies is that State Farm was founded by an Illinois farmer, George Maherl, who was offended that big insurance companies charged the same rates for city and farm customers, even though the latter were less prone to accidents. He started his company with the initial goal of providing low rates to Midwestern farmers, hence the name of the company. State Farm from the beginning was a mutual company in which policyholders own shares. In contrast, Allstate was founded by the CEO of the Sears Roebuck Company in 1931 as a way to complement Sears' existing sales of tires, batteries, and automobile accessories. Overhead was minimized by locating Allstate agents inside Sears retail stores and by offering insurance through the Sears catalog. It became a fully independent stockholder-owned company in 1995. The government promotes economic growth and lessens some, but not all, systemic risks. The rapid progress of the American standard of living between 1870 and 1940 was largely achieved by inventions and the innovation-driven accumulation of capital in the private sector. But despite the common description of the late 19th century as an era of laissez-faire, the federal government, aided by state and local governments, provided direct support of the process of growth and also intervened to limit its excesses. In this section, we include not only government measures to make life less risky, for example, legislation to reduce contamination of meat and milk, but also those government policies that supported the overall process of economic growth. The government intervened in the development of the economy in numerous ways. As we have seen in previous chapters, government actions included the Homestead Acts, the granting of land to railroads, the Food and Drug Regulation introduced in 1906 and subsequent legislation, and Prohibition during 1920 to 33. Other government actions included the establishment of land-grant universities and agricultural research stations, the patent system, the antitrust legislation of the Progressive era, and the array of New Deal legislation. both directly aimed at reducing the severity of the Great Depression and providing permanent benefits after World War II, including deposit insurance, banking regulation, Social Security, and unemployment compensation. Other aspects of government intervention had negative effects, including restrictive immigration legislation in the 1920s and high tariffs throughout the period. The remainder of this section discusses a number of these government interventions and actions to foster economic development and mitigate risk. The Homestead Acts have always been controversial. The outright gift of Western lands to anyone who might claim them has been viewed as an interference with the free market. Absent the homestead land gifts, the unregulated role of land speculation might have induced an equivalent number of land settlers, hoping to make profits by buying and then selling land at higher prices. The territories of land available through the homestead grants were more distant from railroads and thus less desirable and valuable than the lands that the government granted to the railroads. Because no homesteading was allowed on the railroad lands, Homestead Act claimants were forced to go outside the bounds of the railroad grants to inferior land. The monopolization of the best lands granted to the railroads forced many farmers into tenancy, renting the more desirable lands owned by the railroads. During the 2 decades between 1850 and 1870, the federal government granted fully 7% of the area of the continental United States to railroads, mainly in the South and West. The resources needed to develop the vast lands and mineral resources of the West lay beyond the financial capability of any single railroad company. Without federal aid, the lands and resources would have remained inaccessible. There was a nationalistic desire to bind into the Union the faraway areas of California and the Pacific Northwest, and the rapid expansion of the railroads was expected to raise the value of the lands retained in the possession of the government. Yet the granting of government land to the railroads was not unconditional. Instead, land was granted in proportion to the completion of a certain number of miles of new tracks, and the government did not turn over title to the granted land until the railroad had delivered on its part of the bargain. The railroad land grants created a complex set of externalities that allowed individual agricultural settlers and business operations to benefit from the increased speed of travel and degree of market access made possible by the railroad. Among these externalities were the provision of fresh vegetables from California, freshly packed meat from the Chicago stockyards sent in refrigerated cars to the east, and a variety of materials sent from Chicago to the Western Plains. As chronicled by William Cronin, Chicago provided the raw materials of the westward expansion, as entrepreneurs floated trees down Lake Michigan from Wisconsin and Michigan to Chicago, where they were sawed into lumber and transported west to provide the wood for houses and barns on the prairie. In return, the cattle herds of the Western Plains were transported by rail to the Chicago stockyards, which in turn supplied the East United States with its supply of beef that arrived in refrigerated rail cars. The Morrill Act of 1862 was one of the most fundamental interventions by the federal government in the process of economic growth. The so-called land-grant institutions resulted from a partnership of federal and state governments in setting aside land to launch both agricultural experimentation stations and state colleges and universities. The Morrill Act established a land-grant college in every state and territory. The resulting state universities represented a national system created by national policy. The Second Morrill Act of 1890 gave rise to a separate set of all-black colleges, most of them located in the southern states. Soon full-fledged research universities, headed by world-leading institutions, such as the University of Michigan and the University of California, surrounded the initial undergraduate college with a wide array of graduate schools and departments. Though most of the funding for these universities and colleges was provided by state governments, the federal government, through the Department of Agriculture, provided most of the funding for the agricultural research activities. The transition of American agriculture between 1870 and 1940 to much higher levels of output per person and per acre relied on more than the invention of agricultural machinery by private entrepreneurs, such as Cyrus McCormick and John Deere. The government played a major role in making modern agriculture possible through the Agricultural Extension Service, which provided the research that individual farmers could not possibly perform on their own. The service did fundamental research on the maintenance of soil fertility, the development of improved crop varieties, the control of plant diseases and insects, the breeding and feeding of animals, as well as those principles which have to do with the marketing and distribution of the products of the farm. The purview of the service encompassed not just farming but also home production, providing information on food, cooking, and nutrition. A challenge was to distribute all of the research information to the local level, which consisted of 6 million individually owned farms in 1929. To achieve this goal, there were government-funded agents in every agricultural county, and demonstrations of improved farming methods were conducted in 56,000 rural communities. The land-grant colleges had to combine their original 1862 mission of providing extended education and technology transfer, particularly about agriculture, with a more general goal of providing college education for the children of farmers. By 1980, the land-grant universities accounted for 18% of the U.S. college student population and 66% of PhD degrees granted annually. The agricultural origin of these colleges and university has been criticized for failing to provide opportunities for the urban working class. There is no labor extension service, there are few short courses, no demonstration projects, no annual fairs, or any similar services for labor comparable with those for agriculture. Perhaps the most important government activity to stimulate growth was the Patent Office and the process of patent approval. Based on the British model as copied by individual colonies before 1776, the principle of patent protection was included in the U.S. Constitution. By 1870, revisions of patent law required that inventors make public the specific details of their inventions, which helped to spread scientific and technological knowledge and encourage the next wave of inventions. The Patent Office was fair, respected, impartial, and not subject to bribes or corruption, and it provided strong protection to inventors and their inventions at modest cost. The transition of the federal government from a laissez-faire regime to one of partial regulation began with the 1887 Interstate Commerce Act, which created the Interstate Commerce Commission and granted it the power to regulate railroad rates. By 1915, the ICC controlled virtually every aspect of railroad transit, just as the railroads began their decline in the face of competition from motor vehicles and, later, commercial aviation. Some of the legislation of the Progressive Era acted to mitigate risks that arose in the conduct of business in the private economy. Diseased or spoiled beef, as well as adulteration and contamination of milk, were addressed by the initial Food and Drug Act of 1906 and subsequent legislation, as discussed in Chapter 7. The 1906 Act was a remarkably rapid legislative response to the appalling conditions in the Chicago stockyards, described in Upton Sinclair's The Jungle. What Sinclair revealed about the inner workings of the stockyards was matched by Ida Tarbell's muckraking exposé of John D. Rockefeller and his Standard Oil monopoly. Rockefeller was described as the victim of a money passion that drove him to get ahead by any means possible, however dishonorable. The 1890 passage of the Sherman antitrust legislation led 21 years later to the Supreme Court decision to break up the Standard Oil Trust. Despite these steps forward to battle monopolies and to lessen the risk of illness caused by contaminated food, ordinary households continued to face an uncertain life in the early decades of the 20th century. States and localities provided regulation of business, enforcing weights and measures. In the 1920s, Herbert Hoover, Secretary of Commerce from 1921 to 1929, achieved in the business world a standardization of sizes, from nuts and bolts to automobile tires and plumbing parts. Together with the assembly line introduced in 1913 by Henry Ford, the standardization of component sizes is a little-known factor that facilitated the enormous expansion of weapons production achieved by the United States as the arsenal of democracy between 1940 and 1945. From today's perspective, most of the progressive legislation was uncontroversial and overdue. However, the prohibition legislation in effect from 1919 to 1933 exerted unprecedented government control over everyday life and was widely detested and disobeyed. The best available estimates suggest that expenditures on alcohol did not decrease as a share of GDP, as decreased consumption was offset by higher relative prices due to illegality. Productivity was not enhanced by the sobriety of employees, for they managed to obtain illegal spirits, sometimes home-brewed, to replace the beer and wine of which they were deprived. Indeed, efficiency was decreased in another dimension, by the forced decentralization of alcoholic beverage production. Additional harm was done by the disappearance of federal alcohol taxes, which had to be replaced by higher income taxes, mainly on the rich. The years covered here, 1870 to 1940, witnessed an extraordinary investment by the state and local governments in both education and infrastructure. This was the period when clean running water and sewer pipes reached most urban homes, an achievement that was largely financed by local governments rather than by private commerce, and that could happen only once in American history. This period also witnessed the development of professional rather than volunteer police and firefighting units. State and local governments worked together to finance the expansion of education from the 1870 attainment of elementary school graduation to a transition that occurred mainly between 1910 and 1940 toward universal high school graduation. Virtually all the regulation of the great inventions of the networked house, Chapter 4, was carried out by state and local government, not the federal government. In the same way, licensing of automobiles and their drivers occurred at the level of state government. Farmers were subject to droughts, deep freezes, flooding, and swarms of insects. Workers, as shown in Chapter 8, were subject not just to unemployment resulting from macroeconomic business cycles, but also to day-to-day and week-to-week uncertainty about the number of hours they would be able to work at their particular employer. The income of wage earners was paid as an hourly wage, and workers were not paid for the hours that were lost when a particular plant shut down to repair the blast furnaces in the steel industry, or because of a temporary hiatus in the arrival of cattle to the stockyard gate. Employment could also be lost at the whim of a foreman or supervisor if a worker appeared to be losing his physical strength, or to punish any worker who complained about working conditions. A risk in rural regions was the loss of savings when the local bank failed, and the risk of insolvent banks spread to the entire nation in 1931 to 33, as 10,000 of the nation's 25,000 banks failed. Over the 1870 to 1940 era, the most important actions to mitigate risk for the average American were achieved by the New Deal between 1933 and 1940. The first legislation with a long-run impact was the Federal Deposit Insurance Corporation, which almost completely eliminated bank failures and the consequent loss of life savings by depositors. Next came Social Security in 1935, which eventually provided a stable retirement income for America's senior citizens. Unemployment benefits began as part of the 1935 Social Security Act, and by 1938 had been adopted by all states. Mitigation of risk was only partial, however, as unemployment benefits never covered more than 40 to 50% of the previous wage income, and were initially limited to 16 weeks, later extended to 26 weeks. New Deal programs enhanced the role of the federal government in promoting economic growth, which was already evident in the Homestead and Morrill Acts of 1862. A priority for the New Deal was the achievement of rural electrification, given the great divide between near-complete electrification of urban homes by 1929, contrasted with a lack of electricity in rural America. The Rural Electrification Administration, REA, created a substantial improvement in the standard of living for many Americans, even in the dismal years when work was hard to find. While the rural electrification effort is usually associated with the Southeast states and the development of the Tennessee Valley Authority, TVA, the REA was a nationwide program and brought electricity to rural communities all over the nation. One Wyoming ranchwoman called the day when electricity arrived, "My day of days," because lights shone where lights had never been. The electric stove radiated heat, the washer turned, and an electric pump freed me from hauling water. The old hand pump is buried under 6 feet of snow. Let it stay there. Goodbye, old toilet on the hill. With the advent of the REA, that old book that was my life is closed and Book 2 is begun. Other New Deal programs were developed to provide jobs and reduce unemployment. The Works Progress Administration, WPA, at its peak in 1938, created 3 million jobs, equal to about 7% of the labor force. The WPA specialized in infrastructure, roads, and public buildings, and is credited with constructing many of today's U.S. post offices. The Civilian Conservation Corps, CCC, hired mainly young men, limited in number to 330,000 at any one time, to do manual work that focused on the planting of trees, increasing the amenities of national parks, and otherwise improving the infrastructure of government-owned land. Michael Darby revealed the bizarre definition of employment in the 1930s that excluded from the employment data those working for government agencies, such as the WPA and CCC, and Darby estimated that the overall unemployment rate in 1941, officially 9.9%, was actually a substantially lower 6.6% when the WPA and CCC workers are counted as having been employed rather than unemployed. Conclusion. The 7 decades from 1870 to 1940 witnessed a revolution in the American standard of living. Previous chapters in Part 1 chronicled advances in food, clothing, housing, transportation, information, communication, entertainment, health, and working conditions. Along all these dimensions, the quality of daily life in 1940 was entirely different from that in 1870, particularly in urban America. Likewise, this chapter has traced the arrival of the modern world of consumer credit, insurance, and government policy that created the institutions of 1940 that more closely resemble those of today than the America of 1870. Consumer credit allowed purchases to be made on the installment plan so that goods could be enjoyed before they were fully paid for, and insurance protected households from catastrophic loss in the case of a fire and provided income protection in the case of the early death from accidents or illness of the family's primary income earner. The shift from rural to urban living brought with it a change in the provision of credit, which in 1870 rural America had been provided largely by local general stores and for farm mortgages by small local banks. As cities grew, a larger share of the population came to rely on urban sources of credit, such as the pawn shop. The use of credit reached a nadir in the 1900 to 1910 decade, As the cash-only mail-order catalogs became an ever-growing source of clothing and implements for the rural population, and as the cash-and-carry department store became a dominant source of supply in medium and large cities. Throughout the late 19th century, more than half of family budgets were devoted to food and clothing, and most of the rest to rent, or for farmers' mortgage payments. So there was not much income left over for substantial purchases of consumer durable goods. That changed as prosperity increased discretionary income between 1910 and 1929. Consumer and mortgage credit flourished during the 1920s. The installment plan, which dated back to the 1850s for major middle-class purchases, such as sewing machines and pianos, became ubiquitous for both rural and urban consumers, working class and middle class alike. Between 1910 and 1925, both the catalog houses and the department stores introduced installment plans as they shifted away from their earlier reliance on cash purchases. The prosperity of the 1920s was fueled by easy consumer credit, as many households were able to purchase their first automobile during a decade that witnessed the increase of motor vehicles per household from 29% in 1919 to 93% in 1929. Also financed by consumer credit were the earliest major electric household appliances, mainly the refrigerator and washing machine. Mortgage credit was especially abundant and facilitated an unprecedented and unsustainable housing boom that ignored the decline in future population growth implicit in the restrictive immigration legislation of the early 1920s. Life insurance was transformed in the late 19th century to an instrument of saving, with each policy having a cash and loan value. By the turn of the 20th century, life insurance was almost universal, not just among middle-class families, but also among working-class households. Life insurance loans became popular as a method of obtaining the down payment needed to buy an automobile or a dwelling. Regulations governed the financial affairs of life insurance companies, requiring that they maintain specified levels of assets sufficient to meet the regular flow of claims. Just as private life, fire, and automobile insurance reduced the risks of everyday life, so the government provided social insurance that the private sector could not or would not supply. Before the New Deal, the primary risk-related government action was the establishment in 1906 of the Food and Drug Administration, intended to reduce the risk of adulteration or contamination of milk, meat, and other food products. More significant measures to reduce risk awaited the 1930s, when the New Deal eliminated the risk to individual depositors of bank failures through the Federal Deposit Insurance Corporation. The risk of a penniless old age was countered by the Social Security legislation, and the risk of unemployment was partially mitigated, at least for a temporary period, by government-administered unemployment insurance. Long before the FDA and the New Deal measures, the federal government had promoted economic growth and development through free land grants to railroads, homesteaders, state colleges and universities, and state agricultural experimental stations. Incentives for innovation were provided by the well-administered U.S. Patent Office. The contribution of running water and sewer pipes to the improvement of the standard of living over the 1870 to 1940 period was largely financed by state and local governments, whereas the network of highways built in the 1916 to 40 interval was funded by a combination of state and federal resources. Although the wiring of urban America with electricity supplies had been financed by private enterprise, the extension to rural America, particularly in the South, was financed by the federal government through the Rural Electrification Administration. Finally, the federal government also intervened to moderate the excesses of monopoly with the 1887 establishment of the Interstate Commerce Commission and the 1890 passage of the Sherman Antitrust Act. Whether a specific government action mitigated risk or promoted economic growth, it supplemented the powerful forces in the private economy that propelled the epochal increase in the American standard of living between 1870 and 1940.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.